So what questions, comments do we have on both what Jason and Stephen touched on? Don't be shy. No questions, no comments?
Hey, Mark, I'll jump in with one. It goes back to Jason, if you're still on the line. Very interested to hear a little bit further on your volatility comment. And I've read recently about sort of the decreasing volatility in the bond market as well. And I was wondering if your thoughts on the second derivative of volatility there also hold.
So I'll start on kind of on the bond port. Given what the Fed is doing, if they're not maybe going to announce a formal yield curve control, but if the expectation is they're not going to raise rates at all until maybe 2025, it basically means the front of the curve is completely anchored. So you get very low volatility there. The thing that's been interesting is if you see across different asset classes, and start with broad equities, fixed income like bonds, credit, FX, that they all were kind of elevated, but where at least in the summer and in the past couple of months, where you saw volatility, still very low was in the rates markets. When you can look at traditional measures like the MOVE index or kind of something the equivalent of the VIX index for treasuries. So it almost felt like the bond market and the treasury market was sort of underpricing volatility. And I think the expectation is that, well, the Fed's going to be on hold, they're going to keep rates low forever. I think where you can start to see some volatility is more in the back end of the curve. And we've seen the 30 years moved more. It's less tethered to what the Fed is doing. It's certainly the most sensitive to potentially to higher inflation because it's going to be less relevant for keeping the rates low in the near term. So I think in terms of what's underpriced in terms of volatility across the markets, it's probably in the treasury market. It's the back end of the curve where I think there's prospects for higher inflation kind of going forward. If we do get inflation, and I think that this is more of a conjecture, and it's certainly debatable whether we will get it or not. I think there's arguments on both sides that are kind of reasonably valid. But if we start to kind of get higher inflation, what you also then get is higher inflation volatility, but then the interest rates, you get higher inflation risk premium priced in. And that's going to appear more in the back end of the curve. So I think there's a chance for back end rates to both rise, and rise more significantly to kind of price this possibility in. I think we need to see some signs of that because near term inflation has risen. It's once we're going to get past the next couple of months, it's likely to decline. So this is going to have to be, do we see signs of inflation kind of picking up down the line? I think for that to happen, what we actually need then is kind of to break this sort of disinflation cycle we've had for a number of years is truly significant fiscal policy of, another, over the course of the next few years, a few $1 trillion, not just US, but globally. I think that will really kind of change the dynamic of what the inflation outlook has looked like, but also then what does it mean for interest rate volatility overall. The other thing about this sort of vol argument, it's something that I've been sort of thinking about, going back, 4 or 5 years, and it predates, the pandemic, is that if you also just look at financial markets and how they've evolved, there's a much greater reliance on kind of systematic strategies that can move very quickly. They can de-risk, they can add risk depending on how markets are moved, and that's amplified it. We can go back to the February of 2018 kind of Volmageddon period. There's also just a greater reliance on like ETFs and index products, both on the retail side, but even for institutional investors, they use that to kind of get manage exposure, get in and out, to kind of hedge risk. And so I think as those instruments have become more common, both just to kind of buy and hold, but also as ways for investors to kind of play in the marketplace, that has added another kind of amplifying factor. It's like taking kind of you light the fire of volatility, and this kind of pours gasoline on top of it. So I think structurally, and even going back a few years, the trend towards higher vol is kind of there. And I think now with the pandemic and this sort of wider dispersion of potential macro outcomes, that just kind of adds further, catalyst for this to be kind of the reality going forward.
If I could just follow up really quickly, and don't mean to put you on the spot, but would you be a buyer of like the VIX and the MOVE at these levels?
So I think the MOVE more so. I think the treasury volatility is on the lower side, and if you look across, you do a different vol premium, it's lower there. Not so much on equity vol. I think what's happened is because of the very rapid move in markets from the lows, and I began by saying like since March 16th, the S&P is up 44%, and if you take from like the lows, a week later, it's even up a little bit more. And it's happened so quickly that I think for a lot of investors who are, let's call them real money investors, it could be like more traditional retail, not sort of the retail that's been kind of active in options markets. I think pension funds, endowments, insurance companies that in some way are structurally kind of at neutral or less in terms of their exposure. And this kind of gets into these discussions of, in a world where interest rates are incredibly low, should you even hold bonds in your portfolio? If it's not 60-40, is it 70-30? I think on that argument, there's a structural trend towards increasing the equity allocation. The problem you have is that if you look at where you think your allocation should be, you're probably underinvested, but valuations look like they're relatively rich. I mean, not necessarily expensive, but it's harder to kind of pull the trigger when the markets are at these kind of levels. So I think that kind of fuels the desire to buy optionality until investors are fully invested, which means I think the vol has been kind of elevated because of those factors. And if you just look at the VIX versus the S&P over the past month, the VIX was interesting. It was rising at the same time the S&P was setting all-time new highs up until September 3rd when we had the first day of the sell-off. So you had a positive correlation between VIX and spot price. That's very unusual. It happens, it's like, a few times over the past decade. When it does happen, that tends to precede market corrections. And as the equity markets, the spot market pulled back, you actually saw the VIX decline a little bit. So what it sort of suggests is that it's the options market in this case that was driving the spot or the cash market. And so the cash had to correct, but the vol market didn't. And so I think in terms of buying vol, thinking vol or VIX is going to go higher, I think it's kind of priced for this regime. It might spike up a little bit every now and then, but I think it's not necessarily sort of cheap where you want to kind of hedge outright by buying kind of VIX exposure. I think it's a little more reflective of like a structurally higher kind of volatility environment already.
Hey, Stephen, it's Rob Collerine. I have a quick question. It seems like China is going to be a target in the upcoming debates, but it seems like some of the big successful companies like TikTok, they're saying, we don't care. Do you have an opinion as to the thinking there at that level, as to that kind of neutral type position and welcoming sort of U.S. scrutiny?
Well, I don't think any company welcomes scrutiny, to be honest with you. I do think that that what's going on is a lot politics and part reality. You have real security issues that are not going away the way the whole tech world is set up, that have to be addressed much more practically to protect data and protect net security. I'm not sure TikTok is the national security issue, but it could be a door into national security issues. And I think that's part of the problem. I think these companies, I think the tech world needed some light shown upon them to just keep them honest in terms of, are they doing the right things? And I think when that happens, it helps. But I think the reality is we're going to have a two-tiered tech world between the US and China primarily, with people pairing up. I think there are real issues in terms of where we are versus where China is in terms of technology. I think they're behind us enough that that what the US is doing is actually setting them back some. But the tech world, you can catch up if you have the right amount of investment and have the right expertise. China's not short of dollars or expertise. So I think there's just a gap there. I think the TikTok thing is going to be something we don't talk much about after too long. I think there are going to be bigger tech issues between the two countries that are bigger problems.
Jason and Stephen, I'm curious, given your presentations and your forecasts, if there are any basic assumptions underlying those forecasts, whether it's in the way of vaccines or no controlled resurgence, or if it's all based on central banks and technical analysis and kind of what happens in the economy with COVID are just kind of speed bumps, and the macros are just dominating the fact that there's such an aggressive and sustained MMT going on around the world that's just dominating everything else is just noise.
So maybe I'll
Tracy,
take a crack at it. Sure. So I think if you what's driven the recovery thus far, I think you can point to central bank policy. I think that's been kind of, the biggest driver. And the fact that we've seen, growth data get better as we've recovered throughout the summer, a little bit better than I think expected, if we go back to the May, June time period, and even maybe early summer when we had a bit of a second wave in the US where I think concerned this would kind of derail the recovery, and that hasn't been the case. So it's the fact that we have had that, where interest rates have not moved at all, even with better economic data, I think the Fed being on hold and sort of giving the signals that they're not even thinking about raising rates. I think all that collectively has lifted all kind of risk assets overall. So I think that's been the number one driver. In terms of our outlook kind of going forward, we are certainly assuming that we'll get probably a vaccine that's rolled out, widely to the public, certainly in developed markets by middle of next year. So sort of economic activity can normalize. But I think even irrespective of the vaccine, specifically, I think what we're seeing as we kind of go now 6 months into this, that sort of medical solutions are incrementally getting better. So just something as simple as the ability to test people and get results, more quickly, where in some cases you can get results in 15 minutes. Those kind of tests will be made available, I think on a wider scale, like Abbott Labs developed one that they said they'll be available like 60 or 70 million tests per month available by December. So if you just think about the travel, like if you could go to the airport and get a test and get your result and you're good, then you can get on a flight and everyone on the flight is okay. Even if we don't have a vaccine, I think that gets people more comfortable. So I think in different ways, we're adapting to dealing with the situation. A vaccine is part of it. I think that's ultimately kind of the key to fully having sort of normalization. But I think incrementally, we're kind of, progressing in that direction. And it's been surprising to me, like how resilient, say consumer spending and consumer activity is, even as, we had their kind of, their kind of second wave activity in the summer. I mean, it's a simple data point, but if you look at Open Table, their restaurant reservations, when I saw like the latest data about a week or two ago, it was at sort of a post-COVID high of like, it was about 65% nationally from what it was pre-COVID, whereas at the lows, it was like basically zero. And you see that kind of tick higher. So people are getting more and more comfortable of just kind of going out and sort of altering their behavior. And I think as we get better sort of medical treatments and solutions, both on vaccine, testing, and therapeutics, that's going to all improve. So we're assuming that kind of normalization activity through those kind of combined factors. I think the central banks are more like, kind of the puts that kind of keep, asset prices from falling too far. And in some way, I think that the medical situation, it's almost as if you have a portfolio of call options, because if the Pfizer vaccine doesn't work, maybe AstraZeneca's works or someone else's. So I think thinking that there's enough solutions coming is going to also kind of give investors comfort that you can't fall too far because you're just going to get better news along the way. So that's how we're thinking about the, the environment over the next 6 to 12 months.
And I would just add, Jim, I agree with a lot of what Jason says. We don't view our generally positive on the outlook because of gradual improvement, a snapback, and whether it's middle of next year or some other time, that's not the real issue. For us, the issue is how stuff is really moving forward in a much more aggressive way to based on the stimulus that's been put, both fiscal and monetary stimulus. Because the fiscal stuff is a big part of it. So that's a big part of it. So we're actually quite positive on the things that have been working are going to continue to work. We're not as positive on the rotation to value. And Duncan asked a question on that. How do you manage it with the tech names being at kind of valuations prior to the pullback and in some cases after? I think you have to go and figure out what the math looks like on those. And for the ones you want to hold for the long term because they didn't get too stretched, you want to trim and you want to trim the ones you want to hold for long term and take what the market's giving you, and want to sell out the ones that you think have gotten way too far in the future. So I have a hard time seeing how value snaps back without the economy opening up, since we're slow on, or when the economy gets back to normal. I think it's going to be a slower rotation. So we're staying in the camp of favoring the growth names while selectively picking targets that might look more attractive in the value area.
Other comments, questions?
Hey, Mark, this is Andres.
Yes.
This question is for Jason. Jason, you mentioned the importance of international asset allocation. Could you elaborate on what best regions you see, what assets would be better to invest? I'm particularly interested on your thoughts about emerging markets, in particular Latin America. So I don't know what industries you see more attractive, whether it's infrastructure, energy, mining, any comments on that would be appreciated.
Sure. So, I mean, thinking about that emerging markets, that's interesting is, I think what we would have conceived of them during, say, the BRICS period from like 2003 to 2008 as this kind of rapid kind of industrialization that would have benefited from financials, energy, materials, things of that sort. That's not what EM equities are. So I think one, if you start from just a broad kind of index and we take the MSCI, EM as kind of, at least the conventional benchmark. One, if you look at the composition of, the countries in there, it is a very Asia-centric, allocation at this point in time. I think with China, Taiwan and Korea collectively accounting for like over 50%, and in Asia in general, over about 75%. So I think it's important to think about when you say EM, like, is it, what region? Because the index itself is basically a play for the most part on Northeast Asia at this point in time. The other thing that's interesting is that the composition of the industry or the sectors has changed. So it's gone from being something that is more cyclical and value oriented to increasingly looking like a, more growth focused, because tech stocks, led by China, but also parts of, Korea, Taiwan, and other parts, they've become a much bigger piece of the EM equity index. So what was a sort of index or market that would have been very tied to the global economic cycle and a little more value and cyclical oriented is becoming a little bit more actually looking like the US, where it's increasingly the tech sector and the growth stocks are kind of taking a bigger share. So that would be my first point about investing in EM, that it's a maybe a little bit less sensitive to pure economic recovery globally than it was. I mean, I think it's still the case. It's a smaller asset class and a little bit more sensitive to flows, but I think that composition has changed. I think it's important to realize what you're buying in terms of companies and exposures is different today than it was, 10 years ago. Then thinking about Latin America specifically and some of the sectors you mentioned, this kind of follows a little bit Stephen's comments in the prior answer, that when we think about like what could do well in the next 6 months, and this kind of gets into the value and kind of growth trade or the cyclical rotation trade, until we see signs of, I think in high confidence that the global recovery is really taking hold. I think for value to outperform, for some of these sectors to outperform, it's going to be challenged. Not that they would underperform, but I think to really kind of outperform where you want to rotate and sell a lot of growth and buy value, I think that becomes a little bit constrained right now, which means those markets that are going to be a little bit more sensitive to that could be, not necessarily poor performers, but they may not necessarily outperform, in the next, say, 6 months. When we think about sectors, and this applies more to the US, but I think this would be applicable to emerging markets. One of our preferred sectors is industrials in the US. It's a play on the global economic recovery hitting hold. I think, and as a result, something like that could be applicable, I think, in other regions, certainly in Latin America overall. We're constructive on commodities. So those that would be a little bit more commodity exposure and base metal exposure could benefit from that. We're seeing, some of the data like in China, that inventory levels are low, that there's some demand for more traditional commodities. So whether that's, benefits a country like Chile that has high copper exposure, that's a positive. We're constructive on oil more on a 12-month horizon. So again, that could benefit, Brazil, all equal. So it depends on sort of the country and what the market exposure is and their sensitivity. I think you have to be a little more selective as opposed to thinking about EM right now in general being a region that you want to allocate to, until I think we get a little more comfort that, we're kind of out of the clear in terms of some near-term risks and we can get a full, clear cyclical and global recovery.
Agreed. Thank you.
Other comments, questions?
I have a question for Stephen. You mentioned that jobs numbers might not go back to normal with the recovery and having to deal with the debt and the tech issue. Do you see any particulars on the trend of robotics and automation related to these points you made?
That's a great question, Zach. And part of what we think is holding back the employment numbers when even if you onshore a lot of stuff to the US for manufacturing, there will be a lot of robotics there because, the problem that these guys all have is if you're trying to compete in a deglobalized world, then you're going to have to keep your costs down to compete. And that means that you're going to have to bring in more robotics and have less manual labor, and more automation is going to come in. So I think it's a critical point for how the manufacturing renaissance that's occurring in the U.S. but how all these countries are going to have to deal with it, because labor costs are too high, and if you can control it and be more productive with robotics, you're going to do that. And I think people are going to be much more aggressive at finding ways to automate functions and tasks